we're going to call this a look behind the curtains of Curran Financial Partners' investment management process. If you've ever gone through our planning process, you'll see that we put an emphasis on income planning, staying between your navigational beacons, a sustainable drawdown rate, optimal ways to elect your Social Security, taxes, health insurance, long term care, securing health insurance under the age of 65. So, when we're going through our planning process, oftentimes investment allocations kind of gets kicked to the back of the bus or gets brushed over at the end of the visit. Now, this is somewhat by design because if you read both of the books I wrote, investments are the very last chapter in the book. And I say point blank, I'm of the thought that investments are the least important part of having a well funded, well designed retirement plan. Now, as I say this, you could almost get the sense that we don't put a tremendous amount of time, energy, effort, importance on the investment selection and the investment management process. So I wanted to record this just to kind of show you all behind the curtain what we do for our clients as it pertains to the ongoing management of their monies, as it pertains to the tweaking and the alterations of the portfolios that we run here in-house. And hopefully this will give you a better understanding or some peace of mind that we haven't fallen asleep at the wheel. We ongoingly look at what you own and we make thoughtful adjustments if things aren't working within the different portfolios that we run here. All right, so before I go into kind of some of the nerdy stuff, I want to give you kind of a big picture understanding of our philosophy as to how we build models, how we deploy money into different instruments or the capital markets out there. So there's a guy by the name of Ray Dalio. And Ray Dalio recently stepped down, but he built and ran the largest hedge fund on the face of the earth. It was called Bridgewater. And he wrote a book called Principles, and Principles talks about the principles he used to amass a multi-billion dollar fortune for himself and how he built the world's largest hedge fund. Tony Robbins shined a light on him in his book Money. And most recently, there was a book, I think it was Tony Robbins' book called The Holy Grail of Investing, and they talked about Ray Dalio again. And spoiler alert, the Holy Grail of Investing is owning a multitude of uncorrelated assets, right? So you want to own things that zig when the market zags. You want to own certain instruments that just kind of go up year over year with no correlation to the overall bond market or the stock market. And then you want to own things that are actually correlated to the market, things that aren't correlated to each other. But in the book Money, Tony Robbins digs into Ray Dalio and he says, hey, how should people invest their money? And Ray Dalio said, I've amassed quite a fortune over the course of my life, and I told my family that if I die, this is how I want them to invest their money. And because he said, I'll be darned if I've worked my tail off to build up all this money, and then my surviving spouse or my kids go to some hedge fund manager who has some harebrained idea, invests it in something stupid and squanders it all. So what he said is, I created what's called an all seasons model. Mind my terrible writing here. It's not as easy on this whiteboard as you would think. And his all seasons model, this isn't exact, but it just looks easier if I draw it out this way. It's a peace sign, basically. And he said, when I kick the bucket, I want my surviving spouse or my children to take a third of the money and put it in long-term growth-oriented investments, take a third of the money and put it in what are called value stocks that produce dividends and income. I think I just spelled dividends wrong. And then finally, I want to take a chunk of the money, a third of the money, and I want to put it in treasuries. Boring, secure treasuries. Okay? So the world's largest hedge fund manager, one of the wealthiest people on the face of the earth, said, hey, that's what I want my surviving spouses to do with their money. my surviving spouse, my children. I want them to do that with their money. So I took a page out of his book because I have the same pact with my wife. I said, honey, if I die, I'll be darned if you take our money and you go to some other financial advisor and they start putting you in a bunch of, life insurance products or annuities that are no good. So what we said is, why don't we create what are called all-weather models? Because I'm not creative. Instead of all season, I call them all weather. And very similar to what Ray Dalio did, we created 3 different tiers, and each one of these components is a model that we manage in-house, right? So our growth model, internally we call our Dave Ramsey model. Dave Ramsey is an idol of mine. I know a lot of people don't like, hey, I think credit card points aren't all that bad, but if you listen to Dave Ramsey on the radio, what he tells you to do is put all your money into 4 different mutual funds: growth, aggressive growth, international, and growth and income. And each one of those mutual funds should have a track record having made over 15% per year over 20 years. And a lot of financial advisors go, oh, that's all hooey. There's no investments out there. Indeed, there are. There are growth-oriented mutual funds. We use ETFs primarily. We're not individual stock pickers. ETFs are tremendously tax efficient. They enable us to have a tremendous amount of quality control. If something breaks, we know each one of those ETFs is going to hold a number of different holdings, so you're never going to fall victim to single stock risk. You're never going to have an undiversified portfolio with the way we do it. It's kind of boring, quite frankly. But Dave Ramsey says put all your money into 4 individual mutual funds: growth, aggressive growth, international, and growth and income. We took a page right out of his book. Now, we don't just own 4 mutual funds, but we own a model, which is called our Dave Ramsey model, which I think last I checked only has about 6 holdings in it. So it's actually pretty small, but those 6 holdings encompass probably over 500 individual stocks. On the value side of the equation, we created a model which is called our dividend driver model. And it's value stocks that have an emphasis on dividends and income. And you're going to see in a second, we actively monitor this thing as to generate the highest income possible. And then finally, there's a couple different ways you can solve the treasury component. One, we are big fans of using fixed linked accounts. Now, why do we like those? Because sometimes, the hoity-toity financial people of the world will go, oh, it's unsophisticated to use a fixed annuity. Well, the problem with treasuries, the problem with bond portfolios is when interest rates go up, bonds lose value. If I use a plain old boring fixed instrument, it's not correlated to interest rate markets. I get a set interest rate, or I get a interest that's linked to the market. And when the market goes down, if interest rates go up, if interest rates go down, my principal remains intact. So one way to address the treasury component, well, you could just buy treasuries. We actually run a treasury model in-house. We run a municipal bond model in-house. Truthfully, you're giving up some yield, but there are some clients who say, I want treasuries. I don't feel comfortable owning those things, so we'll put you in a treasury ladder. But what we run in-house is what's called our CALM model. And CALM, just as the name would hint at, is designed to be a turtle. Turtle and the tortoise and the hare. Every time I read that book, the tortoise wins. So what we have in here, short duration bonds, treasury inflation protected securities. We even have some gold and silver in there, floating rate funds, lots of hedge positions, as we'll call them, that will zig when the market zags, as to smooth out the ride and make a boring portfolio that just kind of slowly goes up and to the right. Now, on top of what Ray Dalio did with the all seasons model, I said, hey, we work with some people that are in their 40s. We work with some people that are in their 80s. And I want to have the ability to spice up or dull down our all-weather models based on the individuals that we get to help. That's going to bother me. I got to make that L a little more clairvoyant. There you go. So if I kick the bucket in my 40s, well, we're going to spice up my portfolio with more growth. And we're going to have a heavier emphasis on the Dave Ramsey component of our all-weather model. If I kick the bucket in my late 50s or my 60s, well, I'm going to need a heck of a lot more income. Because Claire is going to, I don't know, maybe take on a pool boy and want to travel the world and check items off her bucket list. So we need more income when we're in our late 50s, 60s, and 70s. Now, if I die in my 80s, I want my wife to have a tremendously boring portfolio. I want to dull this thing down. I want to eat soft foods and a prune each and every day. Excuse me for these colorful analogies. So what we did is we create these all-weather models. We watch these independent components like hawks. You're going to see in a second how we do that. And then we have the ability to spice them up and dull them down based on the individuals that we work with. So case in point, so here's a portfolio analysis software we use. It's called Quanti. And, here's just a few of the different iterations that we have. So here's all-weather balanced growth, right? So that has a heavier emphasis on growth. Here's it's balanced though, so it still has a heavy dose of dividends. Here's all-weather aggressive growth. Here's all-weather income. Here's all-weather balanced. All-weather conservative income with growth. So depending on how much we spice them up and dull them down into each one of these components, we will create a different all-weather model for the individual that we're sitting with. And let's face it, some of you look at me and go, don't lose me a penny. Well, if you say don't lose me a penny, well, we're going to have a heavier dose of the safe component. Calm, fixed, linked accounts, muni ladders, treasury ladders. Some of you have a little more gambler in your blood, and you go, I want to have a more growth-oriented portfolio. Well, we'll spice it up over here. Okay? So you've got all these different iterations of portfolios that we run. Where did it go? So you can kind of look inside of them. Let's look at all-weather conservative income. Okay, so you can see the different components. So, we're agnostic as to the different companies that we work with these ETFs. Right now, we love Vanguard because we think Vanguard's one of the good guys. They keep their fees tremendously low. So you'll see Vanguard and Franklin and iShares and Invesco and Spiders and JP Morgan and a multitude of different ETF managers. Like we're agnostic as to where they go. We're going to pick the best ETF that's on the open marketplace to scratch that particular sector itch that we're looking to scratch. Okay, so if we're looking for a Treasury inflation protected securities ETF, this one we landed on Vanguard, probably because they have the highest yield, probably because their expense ratio is the lowest. And then we're going to actively monitor it, looking at its performance over, 1 week, 1 month, 3 months, 6 months, 1 year, 3 years, 5 years. We're going to look at the expense ratio inside of it. So you can see this particular portfolio's expense ratio is 20 basis points. ETF expense ratios are just rock bottom now. Most of the components within this particular ETF have expense ratios in the single digits. Okay. Then we're going to look at income. If it's a dividend driver model, for instance, our focus is going to be on how do I ramp up the income to the highest level possible. Okay. So now that's how we build the various models. Now let's look under the hood even more. Let's look behind the curtain even more. Our trading team, our investment committee, are looking at the components of these models closely each and every week, but every month we're actually distributing to our advisor team, to our leadership team, and having what's called an investment committee meeting, right? And at the investment committee meeting, we're talking about the different models that we run. This particular investment committee meeting, you could tell we're making some tweaks to our SWAN model. SWAN is actually our most active model. SWAN is an acronym for Sleep Well at Night. We use moving average algorithmic trading signals. When things break through trading signals, we automatically get out or get in a rules-based fashion. So that's outside of the scope of all-weather models, right? Because we run what we'd call more thematic models as well. these have like a theme to them. So those would be, we run a model called Turbo. So all you people who like cryptocurrency, private equity, things that are a little bit more pedal to the metal growth oriented, those are components of our Turbo model. We run a Muni ladder. So people who are a little bit more tax conscious and want to own municipal bonds, we run a Treasury ladder. We run Swan, sleep well at night. Those are just a few. So we do run some one-off models outside of all weather that you can plug into to scratch different itches that you might have in your overall financial life. And some people they like the idea of having some stuff that they can be the talk of the cocktail party, right? I want to own Bitcoin. I want to own Ethereum. I want to own blockchain technology, AI, robotics, all that. So that's all components of what's called our turbo model. Now, what does our investment committee do? So our investment committee, this is the visit that we did in June. You can see that we talked about tweaking the calm component of Swan. Okay. And just to glance over what we did here. Now, this is kind of interesting. A lot of people go, Adam, well, who are you getting your investment guidance from? Well, the beautiful thing about being independent is once again, we could be agnostic, right? So we're literally looking at investment outlooks. In this particular one, he shared Franklin and BNY, T. Rowe Price, PIMCO. We'll regularly look to Vanguard, Goldman Sachs, JP Morgan. And what we're able to do is look at all of these large institutional asset managers, not take any of their advice, hook, line, and sinker, but basically get a consensus of to what all of these big asset managers are saying, and then form our own opinion based on the consensus of all those different groups. So here's some different carriers we're actively searching for. We're actively looking at the performance of each and every one of these models, and the different iterations of the models. We're hyper active of looking at the yield. Like, this is our dividend driver model. You can see the yield at this point in time was 5.84%. That's what we're looking for, a strong yield on our dividend driver model. Here's our money market model. You can see the yield there. Here's some model changes that David suggested. Now, he didn't implement these. He just said, here's what I'm going to suggest we do. The calm component of Swan, I believe there's room for improvement. Now, how could we improve it? Well, one, we can increase the yield. Right now, the yield's 3.75. We want the yield to be 4.3. We could lower the expenses. Right now, the expense is 0.18. We could drop that expense down to 0.06. We can shorten the duration of the bonds that we hold. We can go from 5.59 to 5.37. And by doing all of these things, we're going to improve our Sharpe ratio. We're going to gain more alpha. We're going to have better performance of this small calm component within our SWAN model. And this is an ongoing process, right? So there he's going, hey, what do you think about these tickers? These are why this is the percentage I want to hold in each one of these tickers. This is what we're going to get rid of. This is why we're going to get rid of it. Here's 3 other options you can choose from outside of the one that we currently have. Here's why I like these. They have lower expenses. They have higher yields. They manage a tremendous amount of money, so there's active liquidity in those particular names. Here's why we're going to get rid of this. Here are 2 options we can choose from. So this is all going on behind the scenes with our investment committee. And what I think most people want to know, and you can see here we did this in July. We actually implemented some of those changes. Now there's some tweaking within our turbo model that David wanted to suggest we make. Different investment outlooks. So this month we're looking at State Street and Vanguard and First Trust, sharing this with our advisors, sharing this with our investment committee, looking at performance. If anything breaks down, we're going to make an adjustment. I think what most people want is to know that the individual that they're trusting with their life savings has not fallen asleep at the wheel. They want to know that we ongoingly are looking at capital markets. We have our finger on the pulse of what's going on with bonds and stocks and making thoughtful, pragmatic adjustments. And I hope the point of this video was to show you that we are actively making tweaks to your portfolio. There is a thought process as to how we allocate money. And this thought process might not be right for everyone. Like, I'm of the thought individuals should own boring investments so they can live exciting lives. Every now and again, we'll get people who come in and they go, Adam, I want to put it all in turbo. Or they're individual stock pickers. They love picking stocks. That is not, in my opinion, the key to having a abundant, happy retirement. Take it from me, I've sat down with thousands upon thousands of people. And the individuals that are picking stocks, jumping in and out of different tickers because, which way the wind hit them that day, they can amass wealth. Like, you could amass a great portfolio. But I'll promise you this, you'll always be glued to the ticker tape. You'll always be watching men on wearing makeup scare you on television. And the individuals that I envy, and I'm going to do this with my own money, as I already do, I eat my own cooking, but the individuals that I envy have boring portfolios that generate tremendous amounts of income. They have money in growth-oriented stuff, so when the market goes on a tear, they get to reap the rewards of that. They've got a bedrock of stability with calm and treasuries and safe, fixed, and linked things. They allow their portfolio to crank out interest and dividends. They reap the rewards of their growth periodically. And all of this creates surplus income. Because in my opinion, surplus income is the key of money management. We work our whole lives to pay our mortgage off, to get pay raises, to build up our emergency fund, to ramp up the 401k. Why do we do that? For financial peace of mind. And financial peace of mind comes with surplus income. When you have an abundance of income hitting your bank account each and every month that you have confidence that you can spend, that's the ticket. That's the ticket. Now, the investments are an important component of that. You want to have a well-managed portfolio. You want that portfolio to be adjusted periodically based on what the tea leaves are telling us. And hopefully this was helpful in giving you guys a better understanding of how we're managing money. If there's any questions you've got, by all means, lean into our office, lean into your advisor, and we'd be happy to unpack each one of those models, maybe even a little more granularly. We know there's nerds out there who want to know, why we landed on the Treasury inflation protected ETF that we did in fact land on. And we'd be happy to show you the thought process behind the selection of the different investments that we put into our models. Thanks so much.